Hi, I'm Susie Fabricini, and I am an entrepreneur who helps other entrepreneurs understand how money works. Today we're talking about how to grow your wealth tax-free. So in a previous video, we talked about traditional IRAs and 401ks, traditional retirement accounts. Today I'm going to throw another thing at you, and that is Roth accounts. You can have a Roth IRA or a Roth 401k if that's something that your employer offers. But the difference between the traditional and the Roth accounts has to do with the way taxes are handled. So there are three alternatives for taxing retirement accounts. The first one is you take a tax deduction at the beginning, and that's what we talked about with the 401k and the IRA. They grow tax deferred. You don't pay taxes on the growth as it's growing, and that's also true with the Roth accounts. However, when you're withdrawing the money, it's only with the Roth account that you don't have to pay any taxes on the money as it comes out. So, you can only pick two of those. You get your tax-free growth, and then you choose between getting your tax deduction at the beginning or getting tax-free money at the end. What do you think I like? I definitely prefer to get the tax-free at the end, and I'll show you why. So let's say you've got a Roth IRA. You deposit $1,000. You don't take the tax deduction, and we'll assume an 8% growth over 10 years. So now you're going to withdraw $2,159. So your money more than doubled. Now you get to take that money out and pay no taxes. So you're keeping that whole $2,159. Now we'll look at a standard IRA. You deposit the $1,000. You take your tax deduction on the money that went in. So we're going to say 33%. And so you're saving $330. Yay! Then, after the 8% growth over 10 years, you're withdrawing that $2,159, but now you've got to pay the taxes. And if we're saying that same 33%, now you're paying $712.47. So you're only keeping $1,446.53. So you saved $330 to pay $712. And that is why I like the Roth IRAs better than the standard IRAs. Now, if they're so great, why doesn't everybody do it? There are some limitations. You can't directly open and contribute to a Roth IRA if you're single and earning over $153,000 a year. And let me just also say that these are 2023 numbers that I'm giving you because the numbers change a little bit every year. You can't open a Roth IRA if you are married filing jointly and together you make over $228,000 for the year in 2023. The maximum contribution that you can put into that in a year is $6,500 if you're under 50. If you are 50 and over, you can contribute $7,500. Now, what about the 401ks? There are also limits on Roth 401ks, but they're way different. With the Roth 401k, your contribution limit in 2023 is $22,500 if you're under 50, and it's $30,000 if you're 50 or older. And get this, there is no income limit for a Roth IRA, for a Roth 401k. So you could be making $1 million and still qualify to open and contribute to a Roth 401k. However, if you are considered a highly compensated employee, you fall into a different category where there are some limits. And the way to figure out if you're considered a highly compensated employee, it varies from business to business. So I'm not going to go into it here, but I will do another small video that talks about that if that's something that you're interested in. Look for the small video on that. Now, what about high earners? What can high earners do that don't have access to 401ks? Well, there's a couple of options for them. One of them is that they can still create tax-free income by using cash value life insurance, like a whole life insurance policy. They can contribute a lot of money to that, then borrow against the policy to supplement their retirement. And when you're borrowing money, of course, you're not paying taxes on it. And you don't have to return that money until when you die, they'll take it out of the death benefit. There is another video that is all about whole life insurance, and you can check that out. I go into it a little bit more there. Another thing that you can do if you are a high earner without access to a 401k is a backdoor Roth IRA. And that is kind of a loophole. Congress is trying to close that. They have been trying to close it for a while. They haven't succeeded yet, but by the time you were watching this, who knows? So you want to check on that. But the way that works is you open a traditional IRA, and then you can roll it over into a Roth IRA and pay the taxes as you roll it over. It's perfectly legal to do that right now. So if that's something that you're thinking about doing, I would do it sooner than later. So I hope this was helpful. And don't forget to like and subscribe to my channel.